Hello everyone, this is Tom Vylord from Wall Street Value. Hello everyone, this is Tom Vylord from Wall Street Value, and today we're going over investment checklist tip number 12, and we want to find out if the company can pay their, we want to know if the company that we're investing in, we want to know if the business that we're investing in can pay their bills. So there's a couple ratios we look at to determine if they're able to do so. And the first is the current ratio, and which is the current assets divided by the current liabilities. And this is a liquidity ratio that measures a company's ability to pay short-term and long-term obligations. So in other words, can the company pay its debts? Can they pay their bills with current assets? Can the company pay its debts and bills with the current assets, which includes cash, securities, receivables, inventories, etc.? And since this is a good way of looking at the financial health of the company, it's another good way to tell if the management team is doing a good job managing the debts and the bills and running the company. The current ratio is called current because unlike some of the other liquidity ratios, it incorporates all current assets and liabilities. And we want to see assets much higher than liabilities. So the higher the current ratio, the more capable the company is of paying its obligations, as it has a larger proportion of asset value relative to the value of the liability. The higher the current ratio, the more capable the company is of paying its obligations, as it has a larger proportion of asset value relative to the value of its liabilities. So a current ratio under 1.0 means the liabilities are higher than the assets, which could be a sign of financial trouble. As Ben Graham, the father of value investing, once said, current ratio should be 2.0 or higher. And it's pretty easy to find this. Just go to Morningstar, type in the ticker symbol of the company that you're looking at, and then underneath that page, once that page comes up, go to the key ratios, and it's at the bottom of that page under a tab which says key ratios / financial health. So next is the quick ratio. This measures short-term liquidity and a measure of a company. This measures short-term liquidity and measures a company's ability to pay off short-term liabilities. This has to be 1.5 or higher, and this can also be found in the same section in Morningstar. This is different than current ratio, as the quick ratio does not include inventories. So this ratio uses more liquid assets to pay off liquidities such as cash and cash equivalents. The quick ratio measures the dollar amount of liquid assets available for each dollar of current liabilities. Thus, a quick ratio of 1.5 means a company has $1.50 of liquid assets available to cover every dollar of current liabilities. So the higher the quick ratio, the better the company's liquidity position. And it's also known as the asset test or the quick assets ratio. And lastly is the debt to equity. So we want to see total liabilities. To find this, you simply divide total liabilities by the shareholders' equity. I really like this one because I don't want to invest in a debt-laden business. Ideally, we'd love to invest in a debt-free business. Ideally, we would love to invest in a debt-free business. However, most businesses at some point need to take on some types of debt. However, most businesses need to take on debt at some point. We just want to make sure they're not burying themselves in debt. A high debt to equity ratio generally means the company's been very aggressive in financing its growth with debt. Aggressive leveraging practices are often associated with high levels of risk. A low debt to equity represents the company's taken on much lower levels of debt and lower levels of risk. And for this, we want to see debt to equity at 0.4 or less. So that's it for today. Thanks for tuning in, and I'll talk to you soon.